Supermicro, Broadcom, Lam Research, AMD, and NVIDIA, some of the worst performers. But my next guest sees longer-term opportunity in both tech and financials, saying investment rather than consumption is where the growth is more likely to be. So joining me now to talk it through is Drew Matus, Chief Market Strategist at MetLife Investment Management. Drew, thank you so much for being here today. First, I kind of want to get to your take on the data. It's sort of hard to talk about markets without talking about the influence of the Fed, which then is impossible to talk about without the latest numbers on PCE, the Fed's preferred gauge of inflation. So when you see that running at 2.9%, below 3, but just barely, and above that 2 handle, what do you think that means for future policy?
Well, so I think there's too much focus actually on the inflation numbers right now. I think if you're the Fed, you're more worried about volatility in inflation, creating a difficult environment for companies to kind of forecast what their investment should look like. Thinking about their cost structure. So it's really volatility of inflation, and volatility of inflation is actually pretty low, even though it's on the high side of where the Fed would want it to be. And so then you have to ask yourself, what are going to be the impact of tariffs? And I think the Fed's pretty clearly come down on the idea that tariffs are going to be a temporary push higher in inflation, and then eventually it'll dissipate as long as the labor market is somewhat soft, which I think it is. So if you're looking ahead to the Fed and you're thinking about what inflation means for the Fed, these inflation numbers don't mean anything for September. September, I think, is pretty much baked in the cake with the Fed cutting rates. And then as we move forward, the Fed will probably continue to cut rates on a gradual basis and kind of grind rates lower over time as the unemployment rate story and the inflation story plays out and becomes a little bit more easy to understand.
And so we sort of tackled the inflation part of the Fed's mandate, and you just brought up employment. So let's go there. A new Stanford study coming out basically saying young workers are going to be replaced by AI more so, and it's causing downward pressure on the jobs there. We've been covering it on CNBC today. I mean, what do you make of how that influences job market? And is it near term? Is it long term? How does the Fed need to consider what the future of employment looks like?
Well, I think, if we go back to, go back 30 years when computers came onto the scene, and what you saw there was actually, basically entry-level workers being replaced by computers. And now you're going to have kind of another wave of that. And the real question is going to be, how long does it continue and how pervasive is it? And I think, what it's really going to encourage people to do is think about kind of what job you're going to move into in a way of, how does the human add value in that position, right? So we're going to have less jobs that are rote, day-to-day things, the jobs where people feel like they're stuck. There's going to be less of those jobs where people feel like they're stuck. And hopefully, and I think that this is not necessarily overly optimistic, people will actually create new jobs that encourage people's creative sides, and they're able to use AI to kind of create new things. And we head towards kind of a higher productivity regime, which in the short term creates labor market disruptions. In the long term, it creates more jobs because it creates higher growth.
And so if you put sort of that thesis together, it looks like that's where you're drawing some of your thesis for investments. You're looking at tech and financials because you think we need to invest in the future of technology. Is that sort of where you're going with that?
That's the baseline. I think the downside risk to it all, though, is, if you go back 30 years and you look at the top companies in America and you look at the top companies in America today, there's really no overlap. Right. So we really need to be thinking about, AI native companies coming in and potentially displacing kind of the old school companies and how that might play out over time, or at least keeping an eye on it to see how adaptive companies become in terms of looking at AI as a potential threat to their structure.